Thank you. So, good morning, everybody. Uh, Let me formally welcome you to this yet another session on corporate accounting and auditing paper 10 under the online coaching system for June 2025 term. Now, this is actually the seventh class in this series of lectures on corporate accounting and auditing. And in the last six lectures, we have covered a lot of topics from this corporate accounting and auditing. Mainly under corporate accounting, this time we have covered in detail module number 1, module number 4 and 5. While in case module number 4 and 5, and in case of auditing, for the last two classes, we are taking module number 6, and module number 7 has also been taken partly. So our today's objective will be to cover some of the important topics which are left in module number 7, and if time permits, then to touch upon module number 8 also. Now, module number 7 is actually the corporate audit or company audit, what we can say, while module number 8 is auditing independent institutions. Now, from the viewpoint of the examination, this corporate accounting, this corporate auditing, this particular module is very important, and a total 14 marks question, apart from the MCQs, are guaranteed from this particular chapter. Now, for preparation, obviously, past year or term question paper will be very vital to identify which topics have been already covered, and accordingly, the other topics will be relatively more important. However, this doesn't mean that there will not be any repetition. In professional examination, repetitions are always possible. So, a full coverage with sufficient importance given on the topics yet to be covered in the last examinations will be your strategy to follow. Now, with this opening remark, let me just share the screen first for our today's discussion. I think the screen is visible. So, this is actually the topic we should start from today. Now, audit of various items of financial statement. Now, when we talk about company audit, now company in its financial statement, as per accounting standard or as per Indian accounting standard, need to prepare uh, the balance sheet, the P&L statement, and other financial statements such as cash flow statement. In case of Indian accounting standard, the statement of changes in equity also, as per a given format. Now, this format specifies what are the items of assets and liabilities to be included, what will be the assets to be classified in the current, what will be the assets to be classified in the non-current category. Similarly, current liability, non-current liability, everything is mentioned. Now, an important job of any auditor will be to identify or to vouch, verify the particular item of assets, liabilities, or in PL statement, income and expenditure, and conduct a thorough audit of that type of items or all the items within that category. So, in this particular subtopic, audit of various items of financial statements, we will be discussing upon certain items from peer statement or certain items from the balance sheet, and we'll try to see with what points the auditor needs to be careful of while conducting an audit of those items of financial statements. Now, the financial statements format are provided either in the Company Act, Schedule 3, or in the accounting standards. For example, for cash flow statement, the format is provided in the old accounting standard AST or the new accounting standard Ind AS 7, while the format for PL statement balance sheet is provided in Company Act 2013 Schedule 3. Moreover, there are different categories of balance sheet and PL format provided for different type of organizations following different categories of accounting standards. For example, the companies who are following accounting standard rule 2021, they need to prepare financial statements as per division 1, while the organization which follow Ind AS Rule 2015, they need to prepare the financial statement as per Division 2. Again, finance companies, that is NBFCs, they need to prepare financial statement based on Division 3. Whatever be the case, the financial statement will contain certain important items, and it is the duty for an auditor to conduct an audit of these items of financial statement. In this context, we need to also define the two very important terms which are used in audit. Two most important functions to be done by the auditor is the vouching and verification. Now, the traditional methods associated with audit of financial statement items are known as vouching and verification. Vouching refers to the examination of the authority and authenticity of the transactions that appear in the books of accounts with the help of vouchers of these transactions. That is, vouching is the process by which we try to actually compare and confirm that whatever amount has been recorded in the financial statement, that is correct. The transaction was authorized properly, and the transaction was actually undertaken. It is not a fake transaction. Based on the vouchers, we need to confirm the same, and accordingly, the process will be known as the vouching, a part of auditing. Now, vouching examines whether all the transactions undertaken by the entity have been recorded and nothing has been left out purposefully. Transactions recorded in the books of accounts are supported by documentary evidence, that is vouchers. No fraudulent transaction has been recorded in the books of accounts. Transactions that have been recorded belong to the current accounting year only. It is not of the previous year or for the next year. Necessary vouchers relating to entries recorded in the books are with the client. All transactions are properly authorized, but the person responsible to authorize, and the transactions have been recorded at the correct value, and such values have been calculated correctly. Transactions recorded in the books of accounts are related to the organization, and finally, proper accounting entries have been done against the transactions. On the other hand, verification can be defined as a process of substantiation of the assets and liabilities recorded in the books of accounts by means of physical inspection and examination of legal and official documents, and then forming expert opinion as to the existence, ownership, profession, clarification, and valuation of assets liabilities of an entity. Thus, verification includes verification of the existence of the assets liabilities in the reporting date, examination of the ownership and control of the assets liabilities on the reporting date, examination of the position of the assets on the reporting date, examination of the charges on the reporting, the examination of charges against the asset in the reporting date, examination of accounting of assets and liabilities, examination of correctness of valuation of assets liabilities, and examination of adequacy of disclosure as required by the relevant legislation or regulation. Now, role of management assertions in designing the audit procedure in audit of financial statements. Now, the dictionary meaning of the term assertion is a confident and forceful statement of fact or belief. However, when used in the context of auditing, it refers to some implicit or explicit claims. Now, while preparing the financial statement of the entity, company's management makes various implicit or explicit claims or assertions with regard to the completeness, cutoff, existence, occurrence, etc. for valuation or measurement, rights and obligations, and presentation of assets and liabilities, income and expenditure, and disclosure in accordance with the applicable accounting or financial reporting standards. Since an auditor is to appraise the truthfulness and fairness of the financial performance and financial position as exhibited in financial statement, he must design the audit procedure in such a way that these assertions by management are verified appropriately. What are the assertions? Now, some of the assertions are, first of all, occurrence, that is recorded. For example, recorded purchase has purchase of goods actually recorded purchase represents purchase of goods and actually received during the year. Completeness. That is, all purchases made during the year have been recorded and there is no understatement cutoff. Purchases shall include all records received and in transit as they belong to the relevant period. Then measurement. All purchases have been measured appropriately based on supporting voucher and presentation disclosure. Required disclosures as per regulation, if any, have been appropriately done. So these are the assumptions or claims the management make while preparing the financial statements, and it is the duty of the auditor to check the validity of this claim and accordingly prepare a final report to be submitted to the owner. Now, with respect to assets and liabilities, the assertions are as follows. First of all, existence. That is, for example, the machinery included in the head property, plant and equipment, as shown in the balance sheet, do exist at that as at the reporting as at the period end. Then rules, rights and obligation. Company owns and controls the machinery. Cut off. Purchase and sale of machinery during the year are only included and effective in the machinery balance. Completeness. All machineries owned and controlled by the organization are included under the head property, plant and equipment. Valuation. The machinery has been valued accurately following the valuation principle and depreciation charge is appropriate. Then presentation disclosure. Required disclosure as per regulation, if any, have been appropriately done. Then audit of this financial statement income we will be discussing into two phases: audit of income statement item and audit of balance sheet item. Some of the items only we will be discussing due to paucity of time. First of all, revenue from operation. Revenue from operation comprises sale of goods, sale of services, and other operating activities. The other operating revenues includes any revenue earned by the company from operation either other than its principal activity. For example, discount received, bad debt recovery, etc. For a finance company, revenue from operation primarily included interest income and income from other financial services. Audit procedure to be followed for revenue from operation. Apart from evaluating the adequacy of internal control with respect to revenue related transactions, the auditor shall resort to the following audit procedure to audit the revenue from operation. Occurrence. The auditor should ensure that all revenue items recognized are genuine and no sale transactions have been recorded twice. He may test check a few invoices with accounting entries. Further, he should check the sequence of the sales invoices, review of the recording of unusual transactions, verify the return transactions with invoice, challan, credit note, date, and stock records. Then it should also be obtained. It should also obtain confirmation from few customers to check whether the transactions are genuine, and he should ensure that no fake transactions are being recorded. For services, he must see that revenue has been recognized based on the policy undertaken. Then the second point we need to look into is the cutoff. Here we shall see whether revenue from operation includes the sale made and services performed during the year only. Completeness. The auditor should verify that all the sales affected during the year have been included in the revenue. He should apply the cutoff procedure to determine to ensure that revenues are recognized in the current accounting period and check if year-end sale transactions have been tempered. Then measurement. The auditor shall see that revenues are accurately measured based on applicable accounting standards. Trade discount allowed to customers should be checked. No separate entry for trade discount should be passed in the books. If there is any significant variation in trade discount allowed to different customers, the auditor is required to inquire into the reason for such variation. Finally, the sales tax, insurance charges, etc., collected through sales invoices must be recorded under separate heads. Then, presentation and disclosure. The auditor shall ensure that following disclosure for revenue from operation in respect of a company other than a finance company as per Schedule 3, Part 2, has been done. Disclosure should be available for each class of good. Revenue from operation shall disclose separately in the most revenue from in the notes revenue from uh, notes sale of products, sale of services, and other operating revenues less excise duty. Then, in case of finance company, revenue from operations shall include revenue from interest and other financial services. Discount other than usual trade discount must be disclosed. Similarly, transactions with related parties should be separately disclosed in the notes. In case of a company rendering or supplying services, gross income derived from services rendered or supplied under broad head has to be mentioned. Other income. Other income comprises interest income, for example, other than a finance company, dividend income, net gain or sale of investment, and other non-operating income such as royalty, lease rental, etc. So all these are included uh, in the financial statement. Then audit procedure to be followed. The, income from services rendered supplied under broad head. The second item that we will now discuss is the other income. Other income comprises of interest income for companies other than a finance company, dividend income, net gain of sale of investment, and other non-operating income such as royalty, lease rental, etc. Then, audit procedure to be followed. First of all, to see the occurrence. The auditor shall obtain a list of new fixed deposits opened during the year, along with the information on rate, tenure, and date of investment. He shall obtain a confirmation of interest income from bank. Also obtain a copy of the Form 26 AS of income tax to confirm the interest income and related TDS. He should investigate the investment ledger further to see the new investment made in the other source, such as corporate bond, debenture, and shares, and check the interest on dividend income generated therefrom. He should trace a sample of dividend or interest received from cash book to dividend or interest warrant to investment certificates and their deposit into the bank. He should also check the net gain or loss on sale of investment based on relevant documents such as DMAT and trading account, DMAT and trading account details, transfer deeds, etc. Cutoff. The cutoff must ensure the interest income does not include any unearned income and exclude interest accrued on investment. Then, completeness. The auditor must ensure that all interest received and accrued and dividend received have been in recorded in the recording has been done appropriately. Finally, measurement and the auditor must check the accuracy of the interest calculation on new fixed deposits existing on the date of opening date of the year. He should also see that the dividend income received is accrued accurate. He accurate. In certain cases, dividends and interest are received by the client after deduction of tax. The auditor should ensure that dividend and interest are recorded at gross amount. If interest and dividend is received for pre-acquisition period, the auditor should see whether proper adjustment has been done with the cost of investments for this preparation of dividend or interest. Presentation and disclosure. The auditor shall ensure the following disclosure and first Schedule 3, Part 2. Other income shall be classified as interest income, dividend income, net gain loss, other non-operating income, etc. In case of a company other than a finance company, also this particular presentation and disclosure was done. Next. Another important item to be considered under income statement or the statement of profit and loss is purchases. It is another important element of financial statement and includes purchase of raw material and includes purchase of raw material to be included in the cost of materials consumed in case of a manufacturing organization and purchase of merchandise in case of a trading organization. As a part of the audit exercise, the auditor examines the purchase transactions and related journal control to ensure that there is no material misstatement in the amount of purchase and accounts payable reported in the financial statement. Now, audit procedure to be followed. First of all, occurrence. The auditor must ensure that only genuine purchases have been recorded in the books of accounts. He may examine the purchase order, goods received, and purchase invoices to satisfy himself. Photocopy of purchase invoices should be allowed. Moreover, purchase invoices must be in the name of the entity. He shall see whether all the transactions are approved by the relevant authority. The same is extremely important for purchase from related parties. Then he shall see whether all the purchases are approved by the relevant authority, and the same is extremely important. Cutoff. The auditor should see that only purchases during the year have been recognized as expense. Then completeness. He should apply the cutoff procedure to ensure that purchases affected during the year are only recognized in the current accounting year. Now, the auditing should see, or the auditor should see that purchase invoices should be booked only once the risk and reward incident to the ownership has been transferred. He should careful with the delivery terms such as FOB and CIF. The auditor must see the return transactions carefully based on the relevant documents, and he shall ensure correct accounting for goods in transit also. Then, measurement. The auditor shall see the purchase transaction values have been correctly calculated considering the trade discount applied. Information relating to income tax credits shall be verified. The auditor shall see that appropriate adjustments have been made in this respect. Then presentation and disclosure. The auditor shall see the following disclosure as per Schedule 3, Part 1 for purchases under yield statement. In case of manufacturing companies, raw material under broad heads and goods purchases under broad heads has to be mentioned separately. Second, in case of trading companies, purchases in respect of goods traded by the company under the broad heads and transactions with related parties must be identified. Employee benefit expenses. Employee benefit expenses represents the total amount payable by the organization to the employee. Apart from wages and salaries in cash, all types of uh, perquisites, post-employment benefits, including gratuity, superannuation, leave encashment, provident fund contribution, everything uh, is there in the everything is included in the term employee benefit expenses. In a company, often these expenses constitute a significant portion of the total cost, and hence the auditor must put a special emphasis while auditing this item. While conducting an audit of employee benefit expenses, the auditor must at the beginning obtain a detailed understanding of the company's recruitment, promotion, and retirement benefits, retirement schemes, various post-retirement benefits. He should evaluate the internal control associated with the expenses. He should also see substantial procedure to determine the reliability of monthly cash outflow, consistency with the previous day's figures, etc., so far as to determine an expectation of monthly expenses and whether the same is consistent with peers. Now, what are the audit procedure to be followed? The audit procedure to be followed requires investigation of the following assertions. First of all, occurrence. The auditor must ensure that all expenses, including the employee benefit expenses, are genuine. He should obtain a complete list of employees with data on new hires, their appointment dates, and remuneration in terms and conditions. For a sample of newly appointed employees, he may conduct a complete examination of their appointment and remuneration as per team as per the terms. Similarly, he may collect a list of employees resigned or terminated during the year and see that their performances, that their payments uh, have been made appropriately. He should obtain the payroll registered and conduct the examination of reasonability of remuneration and investigate irregularity if any. He should also see that all adjustments such as outstanding salary, PF contribution, deposit, etc., have been appropriately recorded. Then cut off. The auditor must ensure that only employee benefit expenses relating to the current year are recorded. Completeness. The author shall see that all the employee benefit expenses have been appropriately recorded in the books of accounts, and should also check whether all amount of money deducted from salary have been duly deposited, or if not, the same has been known as a current liability. Measurement. The auditor must see that the total amount of remuneration is correctly determined. He may conduct a test on a sample to check the same. He should check whether the salary discussions have been accurate, salary deductions have been accurate, and post-employment benefits have been determined as per the policy adopted. Finally, the presentation and disclosure. The auditor shall see the following disclosure requirement as per Schedule 3, Part 1 have been duly complied with. Employee benefit expenses shall be shown as a separately salary, wages, contribution to provident fund, then expenses of employee stock exchange scheme, ESOP, and employee stock benefit plan, stock purchase plan, staff welfare expenses. These are actually uh, included under the employee benefit. Now, um, depreciation and amortization. Depreciation is the charge representing the cost of a tangible asset allocating over its useful life. The similar charges for an indefinite asset is known as amortization. Dep- uh, Depreciation and amortization constitute a significant portion of company's total expenditure and hence have a direct bearing on profitability. Hence, the auditor needs to be extra careful in determining the appropriateness, security, accuracy, and accounting of depreciation and amortization. While conducting the audit of depreciation and amortization charges, the auditor should obtain a detailed understanding of the organization's depreciation policy, accounting policy relating to depreciation, and should check the um, validity of the charge and calculation accuracy. Then audit procedure to be followed for depreciation and amortization. In addition, the auditor shall resort to the following audit procedure. First of all, occurrence. The auditor shall obtain the fixed assets register and identify the assets accurate, sold or discarded in the year. Will help him to determine the items of assets and eligible for depreciation and amortization during the year. He may select a sample of assets on materiality consideration and that verify the rates and the amount of depreciation calculated. Then cut off. The auditor needs to ensure that depreciation is charged asset on the assets purchased from it due to on, from it due to put to a date of put to use and not from purchase date. Moreover, he shall also see that in case of company has a policy of charging depreciation on time basis, depreciation on item acquired during the year is calculated from the date of put to use to the year end date, and for items sold from the beginning of the year up to the date of sale. Now, completeness. He must ensure that depreciation and amortization have been charged on all the eligible tangible and intangible assets respectively, and no fake assets have been considered for this purpose. Just okay. The auditor shall see the amount of depreciation and amortization have been appropriately accounted in the primary books of accounts and then posted to the appropriate office accounts. And he shall also ensure the depreciation and evaluate amount has been properly accounted for from valuation reserve. He should also ensure that for any retrospective change in the method of depreciation, due effect has to be given from has to be given in income statement. Due effect has to be given in income statement. Measurement. The auditor shall see that the rate of depreciation is consistent with the rate suggested in the Schedule 2 and the amount of depreciation and amortization has been calculated accurately based on the rates and times involved. He shall ensure that rates have been decided in conformity with the effective life of the assets. He should also see that residual value has been properly determined. He shall also see that in case of change in the estimation of estimation of the useful life, or in case of impairment, the amount of depreciation has been calculated appropriately. Presentation and disclosure. The auditor must see that the following disclosure requirement as per Schedule 3, Part 1 have been duly complied with. First of all, accounting policy for depreciation amortization, then useful life of the assets as per Schedule 1, and residual value and the method of depreciation. Just a minute. Sorry for the interruption. Now, the next item of income expenditure or next item of yield statement that we are going to discuss is finance cost. Generally, finance cost comprises of interest on structured debt instruments such as debenture, as well as traditional institutional finance such as bank loan, secured, unsecured. In order to conduct the audit of finance cost, the auditor must procure the schedule of loan and information relating to all structured debt instruments, the rate of interest applicable, and the tenure of such loan, based on which shall be able to determine the amount of interest. Now, audit procedure to be followed in this case. First of all, occurrence. The auditor shall see whether interest has been provided on all eligible debt instrument and loan. He shall verify the amount of interest payment from bank statement and shall check the same with the accounting entries in the cash book and general ledger. He shall see that interest was paid and provided in respect of terms out, outstanding either for in respect of loans outstanding either for a part or entire year part of. The auditor shall ensure that interest has been provided only for the period the loan was outstanding during the year. Completeness. The auditor shall ensure that interest due but not paid has also not been considered as accrued interest, and the same is appropriately accounted in shown and shown in the financial statement. Measurement. The auditor must verify the calculation of interest payable based on rate, loan amount, and the outstanding period for which the loan remains outstanding. Then he shall be careful with he shall be extra careful with loan items repaid during the year and debentures redeemed during the year. Finally, presentation and disclosure. The auditor must see that the disclosure requirements as per Schedule 3, Part 1 and the various accounting standards have been duly complied with. Now, apart from the just a minute, right. Apart from the items appearing in the PL statement, there are different important information to be shown in the balance sheet. So now we will be dealing with certain items from balance sheet. The first item is property, plant, and equipment. Now, property, plant, and equipment constitute a significant portion of total assets of an entity. According to guidance note on audit of property, plant, and equipment issued by ICAI, the term property, plant, and equipment refers to such tangible issues that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes. and secondly are expected to be used during more than one accounting period. Thus, PPE includes land building, uh, plant and machinery, or plant and equipment, whatever may be. Then furniture, fixture, office equipment, computers, etc. In addition to the guidance note, the audit procedure for PPE is also governed by the relevant accounting standards. There is AS 10 um, or Index 16 in organizations which are required to comply with accounting standards. Now, the audit procedure, first of all, here the procedure will be a bit different from what we have considered in case of PS statement. First of all, existence. The auditor must ensure that the physical verification of the assets to confirm that they exist and under the possession of the uh, client. He must tally the physical verification report with the assets registered maintained by the company at the reporting date. He shall ensure that PPE additions up to the date of verification have been updated in the register. Then he shall demand explanation for an he shall demand explanation for any discrepancies found in the above process, and he shall specifically ensure that assets that are not in the working working condition have been accounted for as deletion. Then rights and obligations. The auditor should verify that PPE additions have been approved by the respective official, and such additions are as per the capital expenditure budget approved by the board for the financial year. He shall also ensure whether appropriate internal processes and procedures like inviting competitive quotation or floating tenders were done before the finalizing the vendor. The auditor shall check that PPE purchase option for PPE purchase provisions are in the name of the client and entails the legal ownership. For land and building, the auditor shall verify the title deed of property. In case of charge is created on any immovable property due to any loan taken from a bank or financial institution, the title right. In case any charge is created on any immovable property, the term loan property, etc. In case any change is created on the immovable property due to any loan taken from the bank or financial institution, hence the original title deed is with the lender. The auditor shall ask the management to obtain a written confirmation from the lender in this respect. In relation to all decisions, he shall verify management's rationale for deletion. He may also seek any report from the technical expert, if any, that also led to such decision of deletion. He shall also verify whether such deletions are appropriately authorized, followed by the established internal procedures like inviting tenders and properly recorded in the books or accounts. Then cut off. The auditor shall see that net block of assets shown in the balance sheet comprises all assets existed and under ownership of the company on the reporting date, and depreciation pertains to the current period only. Next, completeness. He shall also verify that PPE schedule assets class wise maintained by the management and tally with the help of tally the closing balances of entities books of accounts. uh, he should check the arithmetical accuracy of the movement in PPE schedule and reconcile the operating balance with the closing balance of each class or assets by considering the following valuation, by considering the additions and disposals during the year. Next is valuation. The auditor shall see that all the items of PPE have been carried at a cost plus account accumulated depreciation less accumulated impairment loss. The cost for this the cost for this purpose includes all costs incurred to acquire or construct the PPE and all subsequent costs to replace part of the PPE. However, every day serving costs should not be included. They should be charged to profit and loss. Next, he shall also verify the installation certificate to know the date of installation of the asset. This is calculating pro rata depreciation. Similar other provisions regarding valuation are also there. Presentation and disclosure. In case of a company, the auditor should ensure that all the norms of PPE have been disclosed in the balance sheet of the company under the head non-current assets and subhead fixed assets as tangible assets as per Schedule 3 of the completed Clause 30. He shall also ensure that all the relevant information has been disclosed in the notes to account section. Now, let us be a bit selective and try to find out some important areas only. Now, this is going to be a bit important. Inventory or stocking trade. Inventory includes raw material, loose tools, spare parts, semi-finished goods, and work in progress packing material, as well as finished goods may be ready for sale. Even for some organizations, it includes stock at branch, stock with customer, stock without consignee. Uh, the responsibility for properly determining the quantity and value of inventories rests with the management of the entity. The management satisfies her responsibility by carrying out appropriate appropriate procedures, which include verification of all items of inventory at least once in every financial year. This responsibility is not reduced even when the auditor attends any physical count of the inventory in order to obtain audit dividends. However, mere presence at the time of physical stock count does not effect relieve the auditor from his duty. Rather, the auditor is required to follow a detailed procedure to verify the inventories. Then, coming to the next item, loans. With reference to Part 1 of Schedule 3 of Companies Act 2013, the format of balance sheet loan represents the long-term as well as short-term loans and advances. Audit procedure to be followed existence. At first, the auditor must obtain separate schedule of long-term and short-term loan and advances, and he should verify whether the balances shown in the schedule agree with the respective ledger accounts. Secondly, he should also attempt to obtain written confirmation from those who have been granted fellowship and granted sorry, he should also attempt to obtain written confirmation from those who have been granted the loan and advances. In case of claims made against insurance companies, railways, etc., the auditor should verify that only claims that are admitted that were admitted had been shown as loan and advances. For this purpose, all the related correspondences has to be examined. Then he shall also obtain the copies of the statutory return like IT return, GST return, filled with appropriate uh, authorities and verify whether the amount recorded in past the books tallies with the claims actually made. Rights and obligations. The auditor should also see that loans and advances have been authorized by the memorandum and association, and he should be extra cautious in verifying the authorization of the related party loans and advances. In case of loans and advances have been granted against any security, the auditor shall verify the mortgage deed for the terms and conditions. For unsecured loans, he shall judge the possibility of its recovery. In case advances granted to the employees, the auditor shall examine whether the installments have been deducted from their salary again regularly. Now, with respect to cut-off, the auditor shall see that the value of loan shown in the balance sheet comprises all loans given by the company and outstanding on the reporting date. Completeness. The auditor should see that all the loan and advances that are outstanding on the reporting date have been recorded, and he should also see that all the money recovered against advances have been appropriately recorded against the respective advances valuation. He shall obtain an aging schedule of different loans and a list of loans under litigations. He should also verify that previous year's estimate of doubtful loans, and after a discussion with the management, verify the adequacy of the allowances for doubtful accounts during the year. The auditor shall also assist the management of bad loans to provision account or write-offs. He shall see that write-offs have been properly authorized by the responsible official. Presentation and disclosure. In case of a company, the auditor must see that the loans and advances have been shown under non-current assets and current assets under subheads loans as per part 1 of schedule 3 of the company's return 30. He shall also ensure that all the relevant information has been disclosed in the notes to accounts section. Okay, so those were certain items which we have discussed regarding how they will be considered while an audit is underway. Now let us move on further to some other topic, and if time permits, we will discuss one or two more such topics. Yes. Now let us now start our discussion on another important point in our module 7 syllabus, which is audit report. Concept and definition of audit report. After conducting an audit of an organization, it is the duty of the auditor to communicate to the appropriate authority. Authority here means the appointing authority mainly, his opinion on the exhibition of the true and fair view of the financial performance and financial position of the organization. Audit report is the written communication on the part of the auditor to convey his opinion to the client. According to Lancaster, a report is a statement of collected and considered facts, so drawn up as to give clear and concise information to persons who are not already in possession of full facts of the subject matter of the report. The preparation of audit report is generally the last step of the audit assignment. So, audit certificate. Now, an audit certificate is a written communication of the exactness of the facts stated therein and does not involve any estimate or opinion. When an auditor certifies a statement, he when an auditor certifies a statement, he implies that the contents of the statement are measurable and that he has verified the accuracy of the data. According to Dixie, a certificate is something that makes certain and is thus necessarily limited to facts capable of absolute verification. Now, there are certain important differences between the two document audit report and audit certificate. These are discussed below. Now, first of all, definition. An audit report is a document written in a standard form through which the auditor expresses his opinion regarding the reliability and correctness of an entity's financial statement. Auditor's certificate. An auditor's certificate is a written communication of the accuracy of the fact stated therein. Then, nature. It is an expression of opinion about the financial statement. In case of auditor certificate, it is a confirmation of the countless and of the correctness and accuracy about financial about some matters. Basis of audit. Here, in case of audit report, the audit report is based on the assumptions and estimates, and here that is in case of auditor certificate, the certificate is based on actual thing or fact. Then advice. In audit report, there is a scope of giving constructive advice to the company. In um, the other one, that is, in case of the auditor certificate, no scope of constructive advice exists in the case of certificate. Basis. Audit report is based on the facts, assumptions, and estimates. Audit certificate is based on audit certificate is a formal statement by the auditor which guarantees the accuracy of the facts should state therein. Time of issue, the report is submitted to the appointing authority only after the audit is complete. In case of certificate, the certificate is issued as and when required. Um, then liability of auditor as a report is merely an opinion. If it is not correct, the auditor may not be held responsible unless he is found to be negligent to his duty. In case of the wrong certificate, the auditor will be held responsible. Format. Audit report has to be prepared uh, in prescribed format. Audit certificate is not required to be prepared in uh, standard format. So those were the differences between audit report and audit certificate. On this particular question, we normally find to be repeated in several years. So please make sure that you cover this topic very well. Essential characteristics of good audit report. The following are the essential characteristics of good audit report. Simplicity. An audit report should be simple and easy to understand by the users. It should be written in simple language and should be self-explanatory. Clarity. The audit report should be clear and unambiguous. The auditor must clearly mention in his report the purpose of the audit, sources of information, his findings, and overall opinion. Brevity. The audit report should be brief and specific. While everything relevant must be disclosed, the report should avoid unnecessary detailing. Then, firmness. The report should firmly state whether in the opinion of the auditor, the financial statement represent the true and fair view of the performance and state of affairs of the business. Objectivity. The audit report should always be based on objective evidence. It is very much required to reduce or eliminate biases, prejudices, or subjective evaluation by relying on verifiable data. Then disclosure. The audit report should properly disclose all relevant facts and the truth. The relevance should be decided based on the materiality. Then disclosure. The the audit report should properly disclose all the relevant facts and truth. The relevance should be decided based on materiality of the concerned item. Impartiality. The auditor should be unbiased. The recommendation must be impartial and objective. Information based. Only relevant and accurate information should be included in the audit report. And timeliness. The report should be prepared and presented within the stipulated time. This will help in timely decision making. Now, what are the contents of audit report? Now, the contents of audit report can broadly be classified into three groups as per Companies Act 2013, as per Standards of Auditing, and as per CARO 2016. Coming to this one by one, uh, now the Companies Act 2013 requires every limited company to get its account audited by qualified auditor. The auditor critically appraises the books of accounts of the company and submit his report to the members at the AGM. Members means the shareholders. In this context, Section 143 and some other section of the Companies Act require the auditor to report on certain points. Thus, first of all, as per Section 143, subsection 2, the auditor in his report shall report whether, to the best of his knowledge and confirmation, and as per his opinion, the accounts and the financial statement represent a true and fair view of the state of company's affairs as at the end of its financial year. and profit and loss and cash flow for the year. Secondly, according to section 143.3, the subsection the auditor's report shall also state whether he has sought and obtained all information and explanation from management which to the best of his knowledge and belief were necessary for the purpose of audit, and if not, the details thereof and the effect of such information in the financial statement. Secondly, whether in his opinion proper books of accounts are, as required by the law, have been kept by the company so as to so far as appears from his examination of books, and proper returns adequate for the purpose of his audit have been received from the branches not visited by him. Whether the report on the accounts of any branch office or of the company audited by a person other than company's auditor has been sent to him under the provision, so that subsection of and the manner in which he has dealt with it is preparing his report. Whether the company's balance sheet and profit and loss account deals with the results are deals with profit that the report are in agreement with the books of accounts, whether in his opinion the financial statements comply with accounting standards, and the observation of the observation of the comments of the auditor or financial statement on matters which have any adverse impact on the functioning of the company, whether any director is disqualified from being appointed as director under subsection 2 of section 164, any qualification, reservation, or adverse remark relating to the maintenance of accounts and other matters connected therewith, and finally, whether the company has adequate internal financial control system in place and the operating effectiveness of such controls. Now, section 143.4 states that in case of any matter required to be included in the audit report under this section, uh, is answering negative or with qualification, the report shall state the reason thereof. As per 143.5, in case of a government company where CAG has issued any direction to the auditor appointed by it, the auditor among other things shall include the direction issued by the CAG and the action taken thereon, and its impact on the accounts and financial statement of the company. Similar other areas also are to be discussed in the peer statement of the company. Coming to the content of the report as per standard of auditing, as per SA 700 revised, forming an opinion and reporting on financial statement. The basic element of an audit report are as follows. Type. In order to differentiate the audit report from other report, it must have an appropriate title such as independent auditor's report. Address. The auditor's report should be appropriately addressed as per the terms of the engagement, respective laws, regulation, and terms of engagement generally specify the person to whom the report is to be addressed. Normally, an audit report is addressed to the appointing authority. For example, in a public limited company, the appointing authority is, say, for example, in a public limited company, the audit report is addressed to the shareholders or members. Then, auditor's opinion. The first section of this auditor's report shall include the opinion of the auditor and shall be named accordingly. This opinion section shall mention the name of the client, the fact that financial statements have been audited, the types of financial statement, reference to the summary of significant accounting policies and other explanatory information, and the date and period of the financial statement audited. Coming to another important point, that is key audit matters. In case of audit of complete set of general financial statement, real purpose financial statement of a listed company, the auditor needs to communicate the key audit matters in accordance with section SA 701. These are patterns. These are matters that, in the auditor's professional judgment, were of most significance in the audit of financial statement of the current period. For instance, valuation of goodwill and other long-term assets, valuation of financial statement, law or regulation may also require communication of key audit matters for the entities as well. Additionally, the auditor may also decide to communicate key audit matters for those who are of significant who are of significant public interest. Responsibilities for financial statement. The report of an auditor should also include a section with heading Management's Responsibilities for Financial Students. According to SA 230, the management and, where appropriate, those charged with governance should also accept responsibility for the preparation of financial statement, and also for the internal control currently in place in the organization. An auditor's report must include reference to both responsibilities, and it helps to explain the users the premium behind audit, premium behind the audit connected. Uh, just a minute. Skipping a few important areas which are self-explanatory. Let us now move on to our second part of this company audit report contents. As per CARO's 2016 notification, what are the points to be noted? First of all, notification. The Ministry of Corporate Affairs, Government of India notified in October 2020, on 25th February 2020. This order was issued in suppression of the company's auditor report auditor report order 2016. Accordingly, CARO 2020 is applicable for all statutory audit commences as on or after 1st April 2021, corresponding to the financial year 2021, and the matter specified therein shall be included in such report made by the auditor. Under Section 143 of the Companies Act 2013, on account of every company to which CARO applies. Now, eligible company, which shall apply to every company, including a foreign company, as defined in clause 42 of Section 2 of the Companies Act 2013 and Section 18 of 2013. Herein are referred to as the Company Act, except a banking company as defined in clause C of the Section 5 of the Banking Regulation Act. An insurance company is an insurance company as defined under Insurance Act 1938. Then a company licensed to operate under 8 of the Companies Act. A one-person company is defined as in clause of Section 2, and comparable act, and small companies are small company are defined in clause 85 of Section 2 of the Companies Act 2013. Next one. Matters to be included in auditor's report as per CARO. Some of the points only we will discuss. Non-current assets, whether the company is maintaining proper record showing full particulars, including quantitative details and situation of property, plant and equipment, and full participation of the intangible assets. Secondly, whether these property, plant and equipment have been physically verified by the management at reasonable interval, and whether any material discrepancies were noticed on such verification, and if so, whether the same have been properly dealt with in the books or account. Whether the title deeds of all immovable property, other than the properties where company is the lessee and the lease agreement, are only executed in favor of the lessee. Disclosed in financial statements are held in the same in the name of the company, if not provided If not, provide the details thereof in the prescribed format. Whether the company has revealed its plant and machinery, plant property and equipment, or intangible assets, or both during the year. If so, whether the revaluation is based on the valuation by a registered valuer. Specify the number of change, if any, if change is 10% and more in the aggregate of the net carrying amount of each class of property, plant and equipment, or interest or intangible assets. Whether any proceedings have been initiated or are pending against the company for holding any Benami property under Benami transaction in 1980. Uh, Loan to director and investment by the company. In respect of loan, investment, guarantee, and security, whether provision of Section 185 and 186 of the Companies Act 2013 have been complied with. If not, provide the details thereof. Then maintaining cost records, clause 3.6, where maintenance of cost records have been specified by the central government under subsection 1 of section 148. The new act, whether such accounts are recorded, have been made and maintained. Other items are also there on which the list of the syllabus of this particular module requires certain disclosure, certain mention. Due to paucity of time, we are not going into the details. Now, registration of statutory auditor. This is also another important point under CARO. Whether there has been any resignation of the statutory auditor during the year, if so, whether the auditor has taken into consideration the issues, objectives, and concerns raised by the ongoing raised by the outgoing auditors. Information about financial assets liability on the basis of financial ratio, aging, and expected date of realization of financial statement and payment of financial liabilities. Other information accompanied by the financial statements, the auditor's language of the board of directors, um, and management plans. Whether the auditor is opinion that no material uncertainty exists as on the date of the report, that uh, company is capable of meeting its liabilities existing on the date of balance sheet and when they fall due within a period of 1 year from the balance sheet date. In this way, the CARO 2016 provides a number of important areas, clarifies a number of important areas from which actually we require um, that is required to be presented and disclosed in the financial statement. Then, auditor's opinion in audit report. Now, there are different type of opinion. Mainly, we categorize them into two groups. One is the unmodified opinion, another is the modified opinion. Now, unmodified opinion and audit report with an unmodified opinion is also known as clean report or unqualified report. An auditor expresses an unmodified report when he is satisfied that the financial statement exhibits a true and fair view of the state of the affairs and operations in an enterprise during the period. To be more specific, an auditor issues an unmodified opinion when he finds that the financial statements have been prepared using generally accepted accounting principles which have been consistently applied. The financial statements complied with relevant statutory requirements. They, there are adequate disclosure of all material matters relevant to the proper presentation of the financial information subject to the statutory requirement, and any change in the accounting principles or in the method of their application and the effects thereof have been properly determined and disclosed in the financial statement. Next, uh, just a minute. There may be an modified report or opinion also. While forming an opinion in accordance with SS 700 revised, if the auditor to the auditor's opinion on financial statement is necessary, he shall express a modified opinion, say SS 705, modifications to the owner in the independent auditor's report suggests two such circumstances where an auditor should appropriately modify his opinion on the financial statement. These are the auditor concludes that based on the audit evidence obtained in financial statements as a whole are not free from material misstatement, or the auditor is unable to obtain sufficient appropriate audit evidence financial statements as a whole and not free from material misstatements, or the auditor is unable to obtain sufficient appropriate audit evidence to conclude that the financial statement as a whole are free from material misstatements. There can be three types of modified opinion: qualified opinion, adverse opinion, and disclaimer of opinion. Qualified opinion: an auditor expresses qualified opinion on financial statement when the auditor, having obtained sufficient appropriate audit evidence, concludes that the misstatements, uh, either individually or in aggregate, are material but not pervasive. That is very significant. The auditor is unable to obtain sufficient appropriate audit evidence on which to base his opinion, but concludes that the possible effect of undetected misstatement on the financial statement could be material but not pervasive. In each of every qualified opinion, the heading of the basis for opinion, the heading of the basis for opinion paragraph must be modified as basis of qualified opinion. Then adverse opinion. An auditor expresses adverse opinion on financial statement when the auditor, having obtained sufficient appropriate audit evidence, concludes that misstatements, either individually or in aggregate, are both material and pervasive to the financial statement. Secondly, in case of an adverse audit report, the heading of the basis for opinion paragraph must be modified as basis for adverse opinion. Some of the situation when auditor should express his adverse opinion are: financial statements are properly were prepared on a going concern basis even after planning to cease the operation of the company within next 6 months, and next, adequate provision for doubtful debt has been mentioned. Mm, just a minute. Right. Um, there is inadequate provision for doubtful debt also. Then disclaimer of opinion. Now, the auditor shall disclaim an opinion when the auditor is unable to obtain sufficient appropriate audit evidence on which to base his opinion, and the auditor concludes that the possible effect on financial statement of undetected misstatements, if any, could be both material and pervasive. The auditor shall disclaim an opinion when, in extremely rare circumstances, becoming multiple uncertainties. The auditor concludes that, notwithstanding having obtained sufficient appropriate audit evidence regarding each of the individual uncertainties, it is not possible to form an opinion on the financial statement due to the potential interaction of uncertainties and their possible cumulative effect on the financial statement. An audit report with a disclaimer opinion must include basis of disclaimer. Situations are: auditor was prevented by the management from observing the counting of physical inventory and performing other uh, procedures such as reducing external confirmation of debtors and creditors and bank account balances. Finally, non-receipt of branch audit reports from the from significant number of branches can also be a reason for non-audit of uh, not uh, can also be an important uh, non-receipt of branch audit report from a significant number of branches can also be an important reason for disclosure of opinion. Now, this particular matrix clarifies the situation and the when and what type of report to be submitted. Here we have used two parameters in column and row. First of all, in the column, the parameters are column-wise. The parameters are nature of matter that gives rise to the modification. Either financial statements are misstated or inability to obtain sufficient appropriate audit evidence. Now, auditors' judgment about pervasiveness of the effects of the financial statement. If it is material but not pervasive, then it is qualified. If it is material as well as pervasive, it is adverse. If it is qualified but not uh, if it is financial statements are misstated, inability to obtain sufficient appropriate audit revisions, and now if materials are not it is material but not pervasive, then it's qualified report. And if it is material as well as pervasive, disclosure of opinion should be submitted. So that particular matrix explain which type of opinion should be submitted and when. This we should keep for the time being. Now, this end of this chapter provides some illustration on uh, opinion, different type of auditor's opinion. So you can have a glance of that particular type, different type of opinion and their contents before your examination. However, expected that a question completely on drafting a report is not going to come. Okay. Now, there is another important portion that needs discussion and where from regular questions are coming is internal financial control over financial reporting. In short, we call IFCFR. Now, internal financial control came into existence to promote risk management and governance process within the organization so that instances of organized frauds can be eliminated. As per Section 134, subsection 5, clause E, the term internal financial control refers the policies and procedures adopted by the company for ensuring the orderly and efficient conduct of business, including adherence to company's policies, the safeguarding of the assets, and prevention and detection of frauds and errors, the accuracy and completeness of accounting records, and the timely preparation of reliable financial information. The importance of a sound internal financial control is paramount. Existence of adequate internal financial control not only reduces the burden of the auditor, but also it provides reasonable assurance about the appropriateness of the accounts and results generated therefrom. Now, report on internal financial control as per section 143 clause I of the Companies Act 2013. The report of the auditor should state as to which as to whether the company has adequate internal financial control system in place and operating effectiveness of such control. Again, Rule 8, Sub-Rule 5 um, of the Company Accounts Rule 2014 requires the Board of Directors report of all companies to state the details in respect of adequacy of internal financial control with reference to the financial statements. Reporting on internal financial control of over financial reporting, auditors' responsibility. Now, as per the guidance note issued by ICI in this respect, the auditor's responsibility will be the auditor's objective in an audit of internal financial control over financial reporting is to express an opinion on the effectiveness of the company's internal financial control over financial reporting and the procedures in respect thereof are carried out along with an audit of financial statements. Globally, auditors reporting on internal control is together with the reporting on the financial statement and such internal controls reported upon relate to only internal controls over financial reporting. Accordingly, the term internal financial controls, wherever used in the guidance, noting the context of responsibility of the auditor for reporting on such controls under 143(3) Roman 1 of the Act, per se implies and relates the internal financial control over financial reporting. Now, therefore, internal financial control over financial reporting shall mean a process designed to provide reasonable assurance regarding the reliability of financial reporting and preparation of financial statement for external purposes in accordance with the generally accepted accounting principles. A company's internal financial control over financial reporting includes those policies and procedures that pertain to the maintenance of the records that, in reasonable detail, accurately and fairly reflect the transaction and disposition of the assets of the company. Secondly, provide reasonable assurance that transactions are recorded as necessary to permit preparation of financial statement in accordance with the generally accepted accounting principles, and the receipts and expenditures of the company are being made only in accordance with the authorizations of the management and directors of the company. Next, thirdly, provide reasonable assurance regarding prevention of money or money division, direction of or timely direction of unauthorized acquisition, use, and disposition of the company's assets that could have a material effect on the financial statement. The auditor needs to conduct an audit of IFC effort through a proper planning, followed by testing the design effectiveness of control and operating effectiveness of control, and thereafter report on IFC over effort. National Financial Reporting Authority is going to be our next topic. Now, if we have a discussion on the background, then we find that in order to incorporate governance, the quality of accounting and auditing is critical. Keeping this in mind, the central government established National Advisory Committee on Accounting Standards on NACAS as per Section 210A of the Companies Act 1956 to advise it on formulation and laying down of accounting standards and auditing procedures. The NACAS was replaced by NAFRA, that is NFRA, under the new Companies Act 2013, and the National Financial Reporting Authority is a quasi-judicial organization that oversees accounting and auditing issues. Constitution. The National Financial Reporting Authority was constituted on 1st October 2018 by the Government of India under subsection 1 of section 132 of the Companies Act 2013, and the body will comprise of one chairman who will be an eminent individual with competence in accounting, auditing, finance, or law as chairperson. In audit, in addition, there can be a maximum of 15 members. Then the structure will be accounting standard committee, auditing standard committee, and enforcement committee. These are the three important committees to be included under national advisory, included under NFRA. Function and duties of NFRA. As per section 132 subsection 2 of the Companies Act 2013, the duties of NFRA are as follows. First of all, to recommend accounting and auditing policies and standards to be adopted by the companies for approval by the central government, monitor and enforce compliance with accounting standards and auditing standards, oversee the quality of service of the professional associated with ensuring compliance with such standard, and suggest measures for improvement in the quality of service, and finally perform such other functions and duties as may be necessary or incidental to the aforesaid functions and duties. Now, NFRA's role in accounting and NFRA's role in auditing. First of all, in recommending auditing standard, as mentioned earlier, NFRA recommends auditing standards and standards to be adopted by companies for approval by the central government. Secondly, monitoring and enforcing compliance with auditing standards. For the purpose of monitoring and enforcing compliance with accounting standards under the Act by company or body corporate governed under Rule 3, the authority may review working papers, evaluate the sufficiency of quality control of the auditor and the manner of documentation of the same, perform such other testing of the audit, supervisory and quality control procedure of the auditor as may be considered necessary or appropriate. The authority may require an auditor to report on its governance practices and internal processes designed to promote audit quality, protect its reputation, and reduce risks, including risks of failure of the auditor, and may take such action on the report as may be necessary. The authority uh, may seek additional information or may require personal presence of the auditor for seeking an additional information or explanation in connection with the conduct of an audit. The authority shall perform its monitoring and enforcement activities through its officers or experts with sufficient practice experience in audit. The authority shall publish its findings relating to non-compliances on its website and in such other manner as it considers fit, unless it has reasons not to do so in public interest and it records the reason in writing. Next, the authority shall not publish proprietary or confidential information unless it has reason to do so in public uh, interest and it records the reason in writing. Next, the authority may send a separate report containing proprietary information, confidential information to the central government for its information, and where the authority finds or has a reason to believe that any law or profession or other standards has or may have been violated by the auditor, it may decide on the further course of investigation or enforcement action through its concerned division. So these were some important topic from module number 7. As I have already mentioned that from module number 6 you can expect one full question. Module number 7 also you can expect one full question, and there will be a question, a March question, one from auditing from of different institution and one from company audit. So in that way, if you prepare for company audit well, then you can get 1.5 questions comfortably. Okay, another important, as mentioned earlier, another important module I need to discuss. Uh, it is auditing of different type of undertaking. Now, uh, an auditor may be appointed not only for a company audit but also for audit of other organizations as well. So in this chapter, we will be discussing some important such audit procedure applicable for different type of organizations, such as organization in the education, uh, organization in the hotel industry, organization in the transport industry, etc. Starting with the audit of educational institution. Now, this educational institution of any state in India are generally established and run under the Societies Registration in 1960 or Public Trust Act of the state concerned. Similarly, central education institutions are guided by the respective guidelines or regulations issued by the Ministry of Education from time to time. In some cases, large education institutions like universities are established by central or state government by enacting special legislation. Accordingly, the audit of accounts of these institutions is carried out as per the provision of the legislation or trust deed concerned. In addition, various circulars issued by the central or state government from institutions are also considered while relevant in this respect. Now, the audit procedure for this institution must consider the following aspects. We are going to discuss on a general basis, not every word we are going to explain. First of all, understand the constitution. Now, whatever is the nature of the organization, you must have a clear idea of the nature of the organization because it defines its procedure, its activities. So, and study the trust regulation or act under which the institution has been established and should take note of the provisions regarding maintenance of accounts. In case of state or central university established under the special act, study the regulation formed under the act. Then assess the internal control system. Normally, these institutions have well-organized internal control system. So, evaluate the internal control system associated with acquisition and maintenance of assets, authorization of transactions, etc., before finalizing the audit program. Then consult the minute book. Carefully examine all the notices and minutes of the meeting of the governing body. Senate, Syndicate, Court, Council, etc., and other committees which affect the accounts and finance of the institution. Confirm that the decisions taken for operation of bank account, approval of expenditure have been duly complied with. Then consult the budget. Check the budget allocation to different heads and confirm that all the amount sanctioned beyond budget has been duly approved. Now verify the receipt related transaction. For any education institutions, the most important source of revenue is tuition fee from students. So tally the counterfoil of the fee received with the fee register to see whether they have been duly recorded or not. Check the register to identify whether all the students have paid their fees in due time. If any student has deposited the fees beyond the due date, check whether the late fine has been charged or not and whether the same has been properly recorded. See whether all conditions are whether all collections are deposited in the bank account at the end of the day. See whether total up the various column of the fee register for each month or term to ascertain that fee paid in advance have been carried out and the areas that are irrecoverable have been written off under the sanction of the appropriate authority. Then admission fee. Check admission fee with admission slips signed by the head of the institution and confirm that the amount has been credited to its capital fund unless the managing committee has taken a decision otherwise. Other fees. Verify the collection of other fees such as library fee, session fee, development fee, for fees for hostel, etc., based on the counterfoil and fee registered and ensure that fees have been accounted for in appropriate heads. Next, see that all areas on account such as fee area or fines area have been taken into consideration at the end of the accounting period. Then see that the free studentship and concessions have been granted by the person authorized to do so, having regard to the prescribed rules. Next, confirm that hostel dues were recovered before students' accounts were closed and their deposits of caution money refunded. Verify grants received from the government or other organization based on the sanction letter and bank statement. Ensure that donation received, if any, has been acknowledged and recorded properly in the books of accounts. Then check income from letting out institutional properties based on counterfoil of the receipts issued to the parties. Vouch income from endowments and legacies, as well as interest and dividend from investment. Also inspect the securities in respect of investment held. Then certain payment related items. First of all, salary and wages. Salary and wages paid to the employees must be verified. Examine whether all the expenditure associated with special events like seminars, symposium has been accounted for by matching the expenditure in this regard against the amount obtained from any organization sanctioned by the institution itself. Vouch on regular expenses such as electricity, telephone expenses, etc., broad and available vouchers and accounting records. Vouch purchase of fixed assets, expenditure for construction of college building based on the available vouchers, resolution of the meeting of the purchase of finance committee. Similarly, utilization of grant for purchase of fixed assets, etc., must be separately vouched. Then vouch the refund of caution deposit, examine the payment on account of hostel facilities, and see the investment representing endowment funds for prizes, etc., are kept separate, and any income in respect of the prizes has been accumulated and invested along with the corpus. Verification of assets and liabilities. Conduct physical verification of tangible fixed assets as shown in the fixed assets register and verify investments based on investment register. Then check whether depreciation and amortization has been appropriately charged or not. Verify by refund of TDS in respect of interest. Then carefully examine all the outstanding liabilities such as electricity, telephone bill, TDS, PF not yet deposited. Finally, verification of financial statement. Verify that the financial statement has been prepared in the form and manner as specified by the regulatory authority, complying with the accounting standards and applicable legal requirements. So that was regarding educational institution. Now, let us consider the audit procedure in a healthcare organization, means hospital or nursing home. Here, the audit procedure that must be followed are as follows. First of all, understand the constitution. Study all relevant documents to determine the nature of the organization, whether it is trust or partnership or company. Study the trust deed in case of trust, partnership agreement in case of partnership business, and articles of memorandum association in case of company. And accordingly identify the rules and regulations relating to the management and process of preparation of accounts. Access internal control system. Evaluate the internal control system associated with acquisition and maintenance of assets, authorization of transactions, etc., and determine the scope of the audit work. Then consult the minute book. Carefully examine the notices and minutes of the meeting of the board of directors, managing committee, and other committees, and identify the decision which may affect the accounting. Confirm that the decision undertaken with respect to operation of bank account, approval of expenditure have been duly complied with. Then verify the receipt related transaction in case of a hospital run by the state government or any local government. Vouch the grants received from the state or the local authority based on government order, sanction letter, counterfoil of receipt. Vouch collection from patients admitted to the paying bed based on the patient admission register and counterfoil of the receipt or copies of the bills. Next, vouch collection at various for pathological tests based on the counterfoil of receipts, copies of bill. Then vouch donation based on counterfoil of receipt. In case of hospital having guest house, assess the collection based on the register, counterfoils of receipts and accounting entries. Next, interest and dividend income should be vouched with reference to the investment register and interest and dividend warrants. Next, in case of legacies and donations which are received for specific purposes, it should be ensured that any income therefrom is not utilized for any other purpose. Next, payment related transaction. Verify that all capital expenditure associated with machineries, furniture, vehicle, etc. is approved and supported by documentary evidence such as counterfoil, check, invoices, etc. Vouch the salary paid to staff based on attendance register, payroll, etc. Examine that appointment of casual staff and payment of other salaries are duly authorized. Then verify doctors' remuneration, which should be doctors' remuneration should be verified based on the list of the visits and operations performed. Verify the purchase of pathological test kits, X-ray plate, and other consumables based on tender orders placed and invoices received, and vouch all other overhead expenses like telephone bill, electricity bill, fuel bill, etc. Based on an appropriate documentary evidence. Verification of assets and liabilities. Now verify the stock register of the medicine, food items, and other equipment and check their valuation. Conduct physical verification of fixed assets and investments based on fixed asset register and investment register respectively. Check the adequacy of depreciated and its accounting. Collect the list of all liabilities and verify them based on the contracts and area bills. Finally, verification of the financial statement. Verify that the financial statements have been prepared in the manner and format appropriate to the manner and ownership structure of the organization. Now, after healthcare, another important organization is hospital in the hospitality sector. Hospitality sector covers a wide range of organization which can broadly be divided into four categories: food and beverage, that is restaurant; travel and tourism; then lodging, hostel and guest houses; then recreation such as cinema halls, theme park, etc. Since the organizations in these above categories largely differ in their business processes, auditing procedure will certainly be different for each of them, bearing a few common areas. The steps are as follows. First of all, steps common for all organizations. Understand the ownership structure of the organization, such as sole proprietorship, partnership, private company, and public limited companies, and determining the regulatory requirement to be examined relating to management as well as accounting. Next, evaluate the internal control and determine the nature, timing, and extent of audit procedure. Check that organization has a valid license from appropriate authority to run the business. Then steps common for the category. Now, first of all, restaurants. Verify the total revenue recognized based on the daily and monthly sales report. Check the revenue has been realized in cash based on bank statement, and check whether area written off, if any, has been duly approved by the person responsible. Vouch all payment made to supplier based on documentary evidence such as orders placed, invoices, and bank records. Carefully examine the petty cash book. Any irregularity found should be examined. Vouch payments on account of rent, electricity, and other overhead expenses. Then vouch the payment of salary based on payroll, attendance register, and bank record. Carefully examine the valuation of stock. Large writing off of any perishable item should be carefully examined, and conduct physical verification of fixed assets and investment based on fixed assets register and investment register respectively. Check the adequacy of depreciation and collect the list of all liabilities and verify them based on contracts and area bills. Then travel and tourism. Vouch the collections from customers based on their booking details, counterfoil of receipts, determine area if any at the end of the year. Secondly, vouch revenue out of commission from the various companies and tour operators. Then vouch the payment made on account of your booking uh, to hotel accommodation, etc. Vouch the payment made on account of your booking divided into air travel, rail travels, etc., hotel accommodation. Vouch transactions related with cancellation of booking. Check that discounts offered to individual customers are approved by the competent authority. Then all overhead expenses, including electricity, telephone, and broadband bills, taxes to local authority, etc., should be vouched based on the respective bills. Verify the salary paid to permanent staff based on their payroll, attendance records, and leave application. Payment of incentive should also be given to them. Uh, Conduct physical verification of fixed assets and investment based on fixed asset register and investment register respectively. Collect collect the list of all liabilities and verify them based on the contracts and uh, area bills. Next, hotel and guest houses. Vouch the collection from broader borders based on their check-in and check-out information recorded in the register, counterfoil of bills and cash book. Verify the room rent receipts and daily occupancy rates. Ask for proper clarification for different rent charged for any border. Be careful while verifying the adjustments of unrealized room rent, cancellation charges, or booking accommodation at the time of closing of accounts. Next, Vouch collections on account of special events such as conferences, wedding ceremony, etc., specifically based on counterfoil of receipts and cash flow. Then income from bar, casino, health center, etc., associated with hotel should be vouched based on counterfoil of bill and cash flow. Vouch the rent from shops situated in the premises of the hotel. Then vouch transactions relating to purchase of food materials, drinks and other materials. Check whether the payments have been made based on the purchase order or contracts, invoices, etc. Verify the salary paid to permanent staff on their payroll. Salary paid to casual and contractual employees should be verified based on the documentary evidence like authorization by the management. Then all overhead expenses, including electricity, telephone, broadband bill, taxes to authorities, etc., should be vouched based on the respective bills. Carefully examine the valuation of stock. If possible, remain physically present at the time of stock taking. Conduct physical verification of fixed assets and investments based on fixed assets register and investment register respectively. Check the adequacy of depreciations, proper ascending, committee, collect the list of all liabilities and verify them based on the contracts and area bills. Finally, recreational facilities such as cinema halls. Now, check whether the appropriate control is in force over tickets of different denominations. Verify whether unsold tickets are kept under lock and key under the responsibility of any official. Vouch the collection based on daily sales report of tickets and entries in the cash book. Check whether collections from advance booking have been duly adjusted. Then vouch collection on account of rental income due to hiring of the hall for special events based on respective contract and counterfoil of receipt. Vouch collection from sale of drinks, refreshment, etc., based on their daily sales report and entries in the cash book. Then check whether the entertainment uh, tax collected as part of the ticket value has been appropriately accounted and deposited within the due dates. See that entertainment tax collection, but not deposited has been considered as liability in the financial statement. Then voucher payment relating to hiring of farms based on relevant contract with the distributor and receipts. Voucher payment on account of advertisement with the advertising agency based on advertising and agent agreement and receipts. Payment to suppliers of refreshments should be vouched based on order places, invoices, and entries in the cash book. Vouch salary paid to staff on payroll, attendance register, and leave applications based on appointment of casual staff must be verified based on appointment letter issued by the responsible authority only. Finally, conduct physical verification of fixed assets and investment uh, based on fixed assets register and investment register respectively. Check the adequacy of depreciation and its proper accounting. Amusement park, let us skip and see what others we have. Okay. Let us discuss this point. Audit of cooperative societies. A cooperative society may broadly be defined as an association of persons who have voluntarily joined together to achieve a common economic objective through the formation of a democratically controlled business organization, making equitable contributions to the capital as required and accepting a fair share of risks and benefits of the undertaking. Elimination of middlemen and sharing of gains of the economic activities seems to be the hallmark of cooperative society. A cooperative society may be formed for different purposes. Accordingly, there may be consumers cooperative society, housing cooperative society, then industrial cooperative society, and industrial cooperative society, urban and rural cooperative society, cooperative banks. Uh, Statutory audit requirement of cooperative societies. As per Section 17 of the Cooperative Societies Act 1912, the register shall audit or cause to be audited by some person authorized by him by general and special order in writing in this behalf the accounts of every registered society once at least in every year must be renewed. The certificate must be renewed. The audit under subsection 1 shall include an examination of overdue debts, if any, and a valuation of assets and liabilities of the society. Third, the registrar or the collector or any other person that authorized to collect, authorized to receive special order in waiting in behalf by the registrar shall at all times have access or to all the books, accounts, papers, and securities of a society, and every officer of the society shall furnish such information in regard to the transactions and working of the society as the person making such inspection may require. Here, the register collect. Okay, now the audit, the register, the collector, or that we have already discussed. The register means a person appointed to perform duties of a register of the cooperative societies under this act. Now, additionally, these points are also to be considered. First of all, qualification of the auditor. Generally, only a chartered accountant within the meaning of the Chartered Accountants Act 1949 can be appointed as the auditor of any cooperative society. However, in certain state cooperative societies act, a person holding a government diploma in cooperative accounts or in cooperation and accounts, or a person who has served as an auditor in the cooperative department of government may also be appointed as an auditor. Appointment. An auditor of the cooperative society is appointed by the registrar of the cooperative societies, and the auditors who appointed conducts the audit on behalf of the register and submits his report to the register uh, or to the society. The audit fees are paid by the society on the basis of statutory scale of pay prescribed by the register according to the category of the society audited. For example, the audit fee of the cooperative credit society and urban cooperative societies are calculated with the working capital at the prescribed rate. Working capital here means uh, working capital here means funds at the disposal of the society, inclusive of paid up share capital, funds built up out of the profits, and monies raised by borrowing and other means. Certain books of accounts are generally maintained by cooperative societies. This include a cash book, a stock register, a register of assets and investments, a register of fixed deposits, register of sureties. What is sureties? Now, in case of a cooperative society, loans are given against personal security of members, as also surety, there is guarantee provided by two other members. The register of sureties will give particulars about the number of borrowers in respect of which a member has stood surety and show whether it is within the overall limit of the suretyship that may. Then there is restriction on the shareholders which is to be investigated. Shareholding in a cooperative society is subject to the limit prescribed in Section 5 of the Cooperative Societies Act 1912. Accordingly, no member of the society, other than a registered society, uh, and 20% of the total number of shares of the society or such number of shares which in value exceeds 1000. A cooperative society cannot prescribe any other limit in its bylaw which is violative of this provision. In addition to this, the act uh, passed by the states may also prescribe other restrictions as regards shareholding. The auditor should see the provisions regarding shareholding is duly complied with. Then there are certain restriction on loan also which needs to be verified. As per Section 29 of Cooperative Societies Act 1912, A registered cooperative society can only grant loans to the customers to the members. Through though with prior approval of the register, it may grant loans to other registered cooperative societies. The auditor should see the loans granted by the by the society are in conformity with this provision. Restrictions on borrowing. Subject to the restrictions imposed by the bylaws, a comparative society may account loans and deposit from its members as well as non-members. It is the auditor's duty to ascertain that the restrictions, if any, laid down by the bylaws are carefully observed. Then investment of funds, there are certain restriction on investment of funds belonging to a cooperative society. Accordingly, a society may invest its fund in any of the following ways: central or state cooperative bank, any security specified in section 20 of the Indian Trust Act, in shares, security, bonds, debentures, or any other corporate society with limited liability, any bank or person carrying on banking business, or a cooperative bank other than a central or state cooperative bank, as duly approved by the register, and in any other manner as duly permitted by the requisite authority. It shall be the duty of the auditor to ascertain whether the requirement as to the investment of the society fund are being observed. Regarding appropriation of profit, according to the Central Cooperative Societies Act, 25% of the profit of a cooperative society should be transferred to a reserve fund before distribution of dividend or payment of bonus to its members. The auditor needs to see that that particular transfer has already been made. Contribution to charitable purpose. According to Section 34 of the Cooperative Societies Act 1912, a registered society may, with the sanction of the register, contribute an amount not exceeding 10% of the net profits remaining after the compulsory transfer. The reserve fund for any charitable purpose as defined in Section 2 of the Charitable Endowment Act 1890. So these points, I think you should keep in mind while discussing a question on what are the aspects to be covered in conducting the audit of a cooperative society. Now, what we find that every year at least one question of 7 marks you can expect from this particular chapter of auditing of different institution, and obviously repetitions over the time I have not seen. In that case, whatever has come in the previous term, you put less importance on that particular topic, and all the other areas under this chapter, you can put more stress on that. Moreover, it is not that when these questions are to be addressed, then you need to write in detail everything, but try to cover as many as points as possible, as many points as possible. Uh, so with regard to auditing, my suggestion always will be to practice based on past term question paper, and it is more required for MCQs because so much syllabus is there. So it is not possible to have a clear or to memorize the entire syllabus. So if it is possible to cover the MCQs from the MCQ bank that the institute has uploaded, at the same time for the past 5 to 10 term question paper, if you just collect and find out the MCQs there from, you can take those MCQs or write those MCQ in a separate place and practice or memorize those MCQs, then it will be to a great extent possible for you to attempt more questions and score good marks. With respect to corporate accounting, practice is the only thing that I can suggest. All the areas you should put more importance. There is this compulsory question coming from the second module, that is on corporate financial statement, and more or less the pattern remains the same. So that is a good area that where you can focus, and also chapter 1 or module 1 is also an area where the focus can be there. With respect to accounting standards, only a few accounting standards are there, so you try to concentrate on those accounting standards where there is numerical problems given, because normally what we can find that numerical problems are coming in the question paper, not the theoretical areas. So you practice the numerical ones even based on the study material for the purpose of the examination. So those few words are very important for this upcoming exam preparation. I think it will be helpful for you if you follow these words and prepare accordingly. Um, if you have any query, then simply you can ask me in this class, or alternatively, let me just mention my mail ID also. It is shopon22@gmail.com. So you can send your mail with your queries, and I will be happy to help you. So with that, let us conclude today. And this is the concluding session for this term. Uh, all the lectures are there in the website and in the archive. You access them and you follow them for having a good preparation. Um, all the best, all the very best for the examination. Thank you very much.